Welcome to Unit 1 for the course on financial modeling and scenario analysis. In this introduction, I will briefly outline the main principle behind financial modeling, and in this particular case, our focus is on firm valuation. Now, financial modeling can be done for various reasons, but certainly one of the most interesting ones is to understand firm value. Now, for instance, if you work later as an equity analyst or as an investor, understanding the value of a company is absolutely essential. The same applies if you manage a company. You want to understand how your management decisions can drive firm value. So in this first part of the course, I will explore in detail how firm valuation is done. So what are the methods behind it and how we can actually do this in practice. The main tool we will use is Excel, and I have to be honest, it is actually quite a good tool for most type of work. However, once it gets a little bit more complicated, it's useful to have a more powerful tool available, and that would be Python. Good, now let's go into this and have a look at the structure of Unit 1. So first I want to think a bit more carefully about financial analysis. So what are we doing in this area? How is it linked to financial modeling? So we talk about firm value, assessing financial health. So this is much more than from the perspective of a bank or another corporate lender, and then also conducting market analysis. Now this is done quite a lot when it comes to issues, for instance, like market entry studies. To understand firm valuation, you have to understand value creation. So put differently, how can companies create value? What's the mechanism behind it? This is absolutely important. So trying to link firm decisions and value, that's the key thing of any good financial model. Then there's the whole area of value-based management that is underpinned by understanding value creation. Of course, here the focus for us is very much on the mechanics. Yeah, we don't talk too much about management implications, but I'm more than happy to expand on that if you want me to. I will then cover some basic concepts around understanding financial statements, cost of capital, net present value, and working with infinite series, because this is in the end what we do when we do evaluation models. And then we move into an example in Excel. All right, now I think it's important to note that whatever we do here is not really what an accountant would do. Yeah, so we don't really do accounting as such. We have to understand, of course, what accounting does. We have to understand the meaning of it. But we are not accountants, and we don't treat financial statements like an accountant would. Our main focus is on understanding value, not accounting figures. We want to understand the economic value of a business. So we have to do an awful lot of work to actually get the true meaning of the financial statement based on a series of adjustments we have to make. And I will talk about this in the additional units. Now let's maybe for a minute talk about my own experience. So my background is pretty much in economics. I also later in life studied mathematics. I moved between various institutions in higher education. So I'm working in higher education for about close to 20 years, I believe, switching between finance and management all the time. I worked in business consulting. I worked for McKinsey in corporate finance and banking with a strong focus on mergers and acquisitions and firm valuation. And I have done lots of consulting work ever since for various clients, mostly around valuation problems, statistical modeling, a fair amount of coding, so data science kind of work, lots of Python, lots of Stata and other things as well. Now, in this particular course, I want to be really quite hands-on. I want to really focus on applications, and I want to give you different options to choose from in terms of learning material. Yeah, so of course we have the slides available online. You will have a combination of some recordings because it's kind of efficient. You can always pause and you can, look at this more carefully. You can try it yourself and continue the video. In the live sessions, I mainly want to have interaction. I want to talk about, the things I cover. I want to cover, any issues, any questions you have. In terms of basic housekeeping, so what are the things you're supposed to do? We have, of course, the assessment to complete. You have. I have to do the marking. We have group presentations during our block teaching period in April. And we also have an exam which will happen online due to COVID issues. In terms of structure, the first part of this course is basically on firm valuation, because I think this is a very important use case. The second part goes more into asset pricing. In the second part, we then move more into Python. So I also provided lots of links to recordings for basic Python. So I would really appreciate if you start looking into that. You don't have to really master all of it, to be honest, but it gives you a much deeper insight into how these things really work. I don't really maintain proper office hours because I'm based in Aberdeen, but if you want, we can always have a chat online, and of course also in April face-to-face. Just drop me an email. Good, so that's basically all I wanted to cover. Material should be on Blackboard as you would expect. Now let's go into this. First of all, what is financial analysis? So what are we talking about, and how is this an important part of financial modeling? To be honest, I would say this area, when it comes to understanding firm valuation, is so fundamental to many jobs in finance that financial modeling, I think, to a large extent is linked to understanding firm value. And that can be done in various things and in various settings. So it's very, very common to use so-called multiples. For instance, a market-to-book ratio or a price-earnings ratio, or modifications of these multiples to understand what's a proper value for a business. Now, this is used in particular when it comes to buying and selling companies, but also when it comes to understanding equity compensation, for instance. So it should be link equity compensation to certain criteria. So designing equity compensation is another area where also I did some work as a consultant. Now what we learn here is a proper method which refers to discounted cash flow methods. And they have been used for a very long time in the industry. And I think it's quite important that you have covered this extensively. And I'm sure most likely you came across this in other courses. But here, in my case, I focus a lot more on the nitty-gritty issues, in particular around adjusting accounting figures. Now, there are different perspectives on firm valuation. There is the inside-out, outside-in perspective. So quite often in this course we take the outside-in perspective because we don't have really private information. We only know what we know based on what a company reports. Of course, that is quite limited in many cases. If you work in a business, what you tend to do is you do an inside-out perspective. So you actually use the same methods to understand how value is created in your business. Now this is useful for all sorts of strategic decisions like, pricing policies, market entry, market exit decisions, and so on. Now, the other big area where I have been quite active is understanding financial health. So this is, of course, really important when it comes to advising clients on optimal capital structure. implications for taxes. So that is quite an interesting area as well. We might touch a bit on it, but not in full detail. And then this whole area of market analysis. So this is quite relevant for market entry decisions. And this then also goes potentially into other areas in management as well. Good, so what's the process behind what we are doing? So the main process is actually always the same. So the first thing we always do is we collect information. Now, this information is very often on the firm level. That's our starting point. So we have financial statements. We might use Bloomberg data stream, other data sources to collect financial data. Then we have industry level data. So quite often industry reports. Then we have country level data. So these are macroeconomic data. Very useful to understand also issues around business cycles and timing decisions. So these are the main sources of information. Nowadays also you have lots of information available on social media and other less structured data that could be used. And then of course it's the process of analyzing data. So here we look and explore financial statements, we look into macroeconomic conditions, political risk, and so on. So our focus in this course is a lot on the firm level. So we don't really talk much about industry country level because honestly that's I think an area where we can expand an awful lot more. And very often this is not really what the equity analyst might do explicitly. So this is then quite often done by economists and other professionals. And what you tend to do is you tend to outsource these activities. In particular, the industry level analysis tends to be done by industry experts. And very often as a finance person, you're not necessarily an industry insider. And then, of course, for us, the big thing is financial modeling. So now we want to build these models. And the main instrument we will use a lot is Excel. Honestly, when I worked in McKinsey, this is more or less the only thing I used. Of course, PowerPoint as well for presentations, but for any modeling, it's certainly Excel. And it's very rare you need something else. Sometimes I use Stata, but it was a bit outlandish, I would say. It's not what you would expect. Yeah. So here we go into some forecasting of various time series, making assumptions, looking at different scenarios. So this is the core thing we want to cover in this course. Yeah. Good. And then of course, it's a lot about communication. That's part of the job. This is something actually I really want to explore in the presentations, that you can also communicate these models in a way people can understand and people can use it then to make decisions. And in particular, being able to communicate these financial data to non-finance experts is actually really, really important. Now, I think also understanding the business context is absolutely vital as well in these discussions. Yeah. And obviously limitations. We have to be honest. We are not able to make perfect predictions. We have to understand, okay, what are sensitivities? What about our assumptions? And all of that can be addressed in modeling and looking at different possible scenarios. And I think this is quite a useful thing to do. Now I just on the slides show you a few examples. So actually this is all based on previous work. I don't really want to go into any further detail. If you want me to, I'm happy to explore this. But basically it's just to show you what is commonly discussed in a business presentation. Yeah, so here for instance it's an analysis of a product mix and a mix of geographic footprint. Yeah, so basically where are you active as a business? And this can be very insightful. Yeah, just by looking at this, for instance, you know that this is all for banks here, that HSBC is predominantly a retail and corporate bank, hardly any activities in investment banking, which of course in 2006 was a pretty good idea, shall we say. Yeah, UBS on the other hand is of course very much the opposite. And Royal Bank of Scotland, it was before it got bailed out, of course suffered from its exposure to the investment banking activity. Now also it's quite kind of, you know, a nice way to communicate a business mix and also geographic footprint. And again, you see very, very nicely that HSBC is truly a global bank. Yeah, that's very much globalized, which again is useful in the case of a financial crisis. Now, there's another example where you decompose what is called the total return to shareholders. Now, the total return to shareholders is a combination of share price changes and dividends. And then you can decompose these into the actual earnings per share and the price earnings ratio. The idea behind that is that a price earnings ratio gives you an assessment of or an expectation of future growth. Yes, if you see a significant increase in your price earnings ratio, your valuation basically goes up for the same level of earnings, and this would capture market expectations of an increase in future growth. Now, whether the expectations are true or false is a different matter. So another example, this gets quite artistic. So this is a map of how companies move along various dimensions. Now this is looking at market to book. So this is one of these multiples. It's a multiple for valuation levels and the book value of equity. So basically a bank that increases in size would increase its equity position, and there are many reasons for that. And a company that increases valuation would, of course, achieve it for the same level of equity. So this is basically the direction you want to travel. This is kind of an interesting thing to look at dynamics. Yeah, so this is quite nice and useful for industry analysis. And that's yet another example, really drilling into profitability analysis. Again, this is something I have done an awful lot. So what you do is you split up profitability measures. So very often, particularly if you work in banking, the measure is return on equity. And then what you do is you decompose it into its component. Well, return on equity has something to do with profits and something to do with equity. And so you can do the profit equity split. Again, you rebase that with assets. It becomes a ratio. Otherwise, you have, of course, size effects in your comparison. This is a comparison for one bank over time. So you see how things are changing. For instance, in this case, what you see is that your operating profit is going down over time, but at the same time your equity base is also going down, which leads to more or less a stable return on equity. Of course, we know already it's 2006, actually 2005, 2006, that this is not a very good long-term perspective. And then, of course, you can look into different revenue types. I don't want to go into all the details for banking. And different types of costs, and you can see how this actually has changed over time. Another thing people like to look at is simply looking at maps and looking at geography. Now this is again it's a market analysis we have done also in 2005. 15 actually. This is a more recent one. Sorry, that is 2015. A market analysis on market growth potential. So that's something interesting if you want to look at geography. Where are the biggest markets? Where do I have high growth rates, for instance? So visualization of data is really, really important in communicating your findings, and also quite powerful in terms of understanding and also making decisions as well. So I think a very powerful figure communicates an awful lot, and this is in fact where I spend lots of time on optimizing the way I communicate my findings. Good, now I move into value creation. So it's just a little thought experiment. So if you think about this, if you give me £1,000 today, or let's say euro, whatever you want to give me, how much money do you want to have back in 1 year's time? Now that's an interesting question. If you ask yourself, what is appropriate, and what are actually the questions you have to ask? I think one obvious question to ask is, no, well, what kind of business are you actually running? How risky is your business? I think that would be a good question to ask. So if it's a very straightforward retail business, standard retail business, stores, all of that, I think I might not be as excited as investing in an online retail company, for instance, because I know it is usually a bit more higher profitability and so on. So it depends very much on the type of business you're running. Now, the following year, I give you more than you had expected. So this is an interesting thing. So put differently, have I created value? That's the interesting question to ask. Not easy to answer because, again, you don't know what you did with it. Because, for instance, I could be very cheeky and take a bank loan and give you more back than you expected. And then you might be tempted to give me even more money in future because you think, oh, what a great return. And then I might take your money and run. Yeah, you never know. Yeah, so end of the day, the main thing to ask is, what are you doing with it? So in terms of operations, what are you actually doing to generate that money? So, and that's the core issue around value creation. Now, this is a slide which I always find really interesting and insightful. It's about what you might call a value mindset. So basically, can we connect our business to what the stock market thinks? So what is the capital market valuation? So one way to look at valuation is to look at this more from an equity analyst perspective. So as an equity analyst, what I do is I look at the stock market. So I look at that. From the stock market valuation, I get a sense of what the market expects. We talked about, multiples and other things. What is the market expecting? Then I can do my discounted cash flow model, which we cover quite extensively in this course, and I can come up with an intrinsic value. And what I can do then is I can compare that with the actual market value, and then I can have a discussion, am I actually under or overvalued based on my assumptions? Intrinsic value, when you do the modeling, is linked to financial indicators. It's linked to so-called value drivers, and we talk about this very extensively. So we talk about here profitability measures and measures of growth, and these in turn are interrelated with your actual operations. Yeah? So actually, what business are you doing exactly? Yeah, and then it comes back to your fundamentals. Your strategy. What kind of business are you doing? Your staff, reputation, and so on. Now, the other way to look at this is actually from the start of your business. You can argue, okay, if I change my fundamentals, what is the impact I have on my operations, on my financial indicators, on my intrinsic value, and then how does that translate into market value? So that is the other perspective. So I think that's fundamentally the main insight. And then from this perspective, this whole value-based management idea is derived, which is I think in many ways very useful, but it's not, of course, I would say uncontested, because you can always make now a very valid argument that what about sustainability? What about ethical issues? What about climate risk? Do these things actually matter in this calculation? The honest answer is, if you talk about long-term value creation, they actually do. You can't really create value in the long term if you rip off your customers. That doesn't work, okay? That doesn't work. It doesn't work in any business, honestly speaking. Even if you run a very unethical business, for instance, you run a criminal organization, you can't constantly rip off your customers because it will destroy your business very quickly. Yeah, so you have to also keep your customers happy. Whatever you sell, I think that is quite fundamental. So if it comes to value creation, many academics have this perspective that it's all about shareholder value, it's all about short term, and it always ignores ethics, sustainability. This is flawed. And again, in my opinion, the main problem we actually have is that most academics never ever worked outside university. They have no idea what they're talking about. That's my opinion. The thing is, honestly, you cannot build a business in the long term if you are not sustainable. You just can't do it. Yeah? You can have a short-term success, but you can't create value in the long term. And you can't, you can't be over generous to your customers, but you can't also rip them off. You have to find a balance. The same is true with developing staff. You have to be reasonable. I think that's the honest truth. There's always a balancing act going on. It's not about optimizing your short-term profits. It's about, generating long-term value, not for 1 year, but for generations to come. So that's an important aspect. Now, so what are the different principles here? So if you really internalize this and you change your corporate culture and you ask yourself, really, how do I actually get there to long-term value creation? You have to always ask yourself, really, what's in there also from a customer's perspective. And I think this is a very interesting mindset. And I think it's quite helpful, actually, if you adopt this mindset. The issue I have with what you might call a stakeholder approach is that you have so many different targets that it becomes conflicting and it becomes muddled and you don't know where you're going. So quite often nowadays there is the tendency that companies adopt targets linked to I would call this actually virtue signaling, which has nothing to do with their actual business. One has to be realistic. At the same time, of course, improving, for instance, your corporate culture, being inclusive, for instance, is in the long-term interest of any business. If you just understand basic demographic change, it would be madness to assume this is not the case. But if you then overemphasize one aspect and you miss all the other aspects, I think it's not helpful. So I think from my perspective, having a long-term value mindset, which in the end is only achievable if you make lots of different stakeholders reasonably happy, is the right perspective. But again, you should have an open mind, and I don't want to tell you what you have to think. You have to think for yourself. I just discuss the issues as I see this happening in businesses over many years. Now, the fundamental thing is you need a long-term perspective on value creation. And I think many companies focus very much on short-term goals because this is what the market sometimes wants and also what the media wants, but this is definitely not what we are massively interested in. In terms of what we do as a financial modeler, we look indeed very much at long-term growth. We look at long-term profitability. We try to predict this over many, many years. And for us, that's the interesting thing where you actually see real value. Yeah, that's the important aspect. Good, I now move into some basic concepts which are linked to financial modeling in general. Now this is an example I worked on this company, Kellogg company. I'm sure you know it if you like your cornflakes in the morning. And I just want to start looking at this and playing around a little bit in Excel without going into lots of details. So what we have is we have an income statement. You should be reasonably familiar with the different terms. And we have also here our balance sheet. So we have our assets, we have our liabilities. And what I just want to do now is I move now into Excel. And I just want to play around a little bit, yeah. And there is already a solution available as well, so we don't have to cover everything here. You can just play around yourself. I just want to point out a few important issues. So usually, of course, what you would look for is, what might be interesting is to look at, of course, your revenue development. So that's always an interesting aspect, because that tells you simply about your growth potential. If you look at this example of Kellogg, you immediately notice that, well, there is not much of any growth happening. Yeah. So in 2015, you have more or less the same figure you have in 2018. So that's not massively impressive. So in terms of how you can develop your business, the growth is not the main driver here. I think that's an important message to note. Yeah. So what tends to happen a lot is, we can just start doing some basic analysis further down. We might look at the obvious thing, like looking at our top line growth. Yeah, so we can do that, and we could try to calculate that. Yeah, so I think that would be helpful. Then we could look into other types of ratios. Yeah, so I think that's usually what I would start first. Yeah. So in this particular case, well, if we look at the growth rate, and if we attribute this to 2018, so what we can do is we can go in 2018, we can divide by what is happening before, and then it depends how we want to display things. So let me just run this like this, and we would see in this particular case a 5% increase. Yeah. Again, we can change here the setting, we can change the format. So you learn a bit about Excel. You do a right click on the cell, do format cell. That's the best thing to do, and you go into percentage, and then you can modify it. I would say 2 decimal places is fine. Now what we have done here is, obviously we have done a calculation. You should be reasonably familiar with that, I suppose, but if you haven't seen this before, that's perfectly fine. Okay, so now what we could do is we could start tracking this along and see what happens. So let me just have a little check here. What does that do? Well, it compares now the 2017 figure and the 2016 figure, so that is reasonable. So that is working fine. Of course, we haven't fixed any of these cells, so we didn't use a $ to fix them. So if we track this along, it will just change. And we just continue doing this and see what happens. So the next one here is our 2016-15 one, and of course then we run into trouble because we are running out of cells. Yeah, so we divide by 0, and of course Excel doesn't like this. It gives us an error message dividing by 0. So we can drop that. So looking at this, of course, it is not an impressive growth you observe. Yeah, so I think that is quite clear. Then we can look at various other ratios. So what tends to be useful is to look at cost ratios. So here we have the cost of revenue. The cost of revenue, or cost of goods sold, is an interesting indication for what is more or less what you might call a variable cost component. Now, so you tend to expect that your cost of revenue, they would change with your revenue. You would expect that it's not an overhead. Overhead are in here in SG&A, and we come up to this in a second. So what tends to be useful is we could look at a cost-revenue ratio. Again, you can do it in different ways, but you could do cost of goods sold relative to revenue. So we could do that. Again, I put the equal to, and I do cost of revenue here, and I use revenue, so it gives me a ratio. Yeah, so it's not necessarily very common to put this in percentage points, and we just quite often leave it as it is, and we just drag it along. And so what we can observe here is that this ratio seems to be pretty much stable. Okay, not much is happening here, so our cost of goods sold relative to revenue are more or less stable. Yeah, so it seems to be a fairly stable cost structure. SGA, sales general administrative expenses, so these are actually overhead or fixed costs It's not a perfect definition, so one has to be a bit careful here, but it's quite often how it's used. So we look at SG&A and we compare this to our revenue. So we do something similar. Again, we could modify here our decimals. That's quite easy, and we track this along. And here what we see is that compared to 2015, there is an improvement in your cost ratio. Yeah. So we don't see something similar here in your variable cost, but we can certainly argue there is a significant drop in your SG&A. Yeah, so compared to revenue, you take out almost $500,000. You see that in costs. Now, from a financial modeling perspective, and as a financial analyst, I would be delighted, because of course that means that my profit margin goes up. Yeah, so that's an interesting observation. Yeah, so that would be a good starting point. Again, of course, we can start visualizing this, and I think I have done this also in the solution. So you can just do a little figure here, so we can tidy this up, and I can call this, for instance, cost ratios. And could do this a little bit nicer. Do a little right click on this one. I can look for select data and edit my horizontal axis and put in the years here to tidy this up a bit. So that's much better. Then I could move this about a little bit, maybe a bit below here. Throw this here. I could also move it into a separate worksheet if I want to. So that looks quite decent. And then I can also put this on a second axis if I want to, but this is of course entirely optional. So we can have a secondary axis here. It makes it easier to compare. So I think that might be useful. So here what we see is that if we go now from 2015 up to 2018, that your variable costs are very similar, but we see a constant, more or less constant drop in my fixed costs. Yeah. If we don't like the way it's displayed, we could change here the axis. We can start in 2015. We can also invert this if we want to. But very often in companies, it's a matter of perspective, what you prefer. Yeah. So you can display this differently. So the main things we just have done here is looking at some basic ratios and telling basically a story. Yeah, and now the total thing we can also do, we can look here at our profit margin, and you see, looking at this, so this could be here our profit margin, and this is combining both costs. Again, there are different types of profit margins. So we could do something like this. We use here the sum function. Take that. So we have 14%. So basically, this is what I get out of my revenue before then, of course, having to consider additional costs like interest expenses and so on. Good, so that is an interesting start. Again, we see here an improvement, and we can argue the main improvement is in cost savings in your overheads, so that would be the main insight. Yeah, so that's the starting point of looking at operating performance. Yeah, so that is quite useful. Later we will of course do this exercise one more time once we have better tools. Yeah. But this is a good starting point, and it's interesting to observe. Good. I move back to PowerPoint, so we will get back into this and discuss this again after learning more about the concepts that we can use to understand performance measures and to understand costs. Yes, the most and easiest way to analyze this is to look simply at inflows, outflows. It's quite simple. What's the money that goes in? What's the money that goes out? And to also look at the split between what is more or less a variable cost component, so this is cost of goods sold, and SG&A, which is more or less a fixed cost. And here the first insight you would get is that they were I think, doing most likely some cost cutting. So that gives you some idea about your operating performance. Yeah, we will talk a lot more about taxation. So we have to note, which we don't know yet, that we should not look at reported taxes because there's a lot going on here. The other thing you might have noticed is we have minority interest payments here. So this is interesting, and this depends on the structure of the business. So if you have, for instance, subsidiaries which you control, but you have some minority shareholders and you have to make some payments to them, this would show up as minority interest in your income statement. We look into this in more detail in the next units. Yeah. Now the asset structure, what we will later do is we will look at operating assets, we will split it up, we will do lots of adjustments to it. So at the moment we only look at the top level here, and what you can see is quite an expansion of total assets. Now this is interesting to note. One has to look into what is the main driver. You see also an increase in goodwill. Again, one has to look into what's the main driver. Quite often this would be an acquisition. Your fixed assets, so this is property, plant and equipment, looks also a little bit expanding, which is interesting because your revenue does not increase. So this is not a fantastic sign. I wouldn't be too happy, because why do you need more stuff for the same level of revenue? Your cash position, this is of course interesting when we talk about financial stability, financial health and other aspects here. We will later talk more about short-term, capital, so working capital management, and we will explore this an awful lot further. Yeah, and already here we talked about this. You see this increase in minority interest. So, and this is quite a significant jump. So this looks as if they control a subsidiary and they sold parts of it. And this is how it looks, but of course this has to be investigated a bit further. This is quite a significant change. You see also, which would concern me a bit, quite a significant change in terms of the debt structure. Now this is interesting, because again we know in terms of operations we haven't done that much. We did not expand our business that much, but debt actually went up quite a bit. Yeah, so that is something we would like to investigate a bit further. So this is a bit suspicious, and definitely something to note. The other thing is, of course, we see a change in maturities. Yeah, so you see the short-term debt seems to get lower, long-term seems to go up. So that might partly offset, of course, what we are seeing, but not quite. It's still quite significant. Yeah, it's just the first impression. So this is something where we have to have another look. The equity position also goes up. Again, of course, the issue there is, if your business doesn't really grow, why do you need all this equity? Because it affects, of course, your profitability measures. Yeah, it affects your return on equity. You only want to have the equity you need to run the business. You don't want to have too much of it that is just sitting around and not making money. So that's something to look into. Good. So we will explore all of these items in a lot more detail. So once we know more about the methods we can use, and we'll explore this in particular in the next unit when we talk about value drivers and how to quantify them. Now, another important concept, and we come back to this in the next unit, is what is called cost of capital. Again, I'm quite sure you came across this in other units, because it's quite fundamental. I'm not sure whether you really understand exactly what's behind it. So I think that the main point just for us from a valuation perspective is to take away that cost of capital is an opportunity cost. This is fundamentally what it is. So from an investor's perspective, the main issue is indeed, what do I expect to get out of my investment? So what do I need to be compensated? And this is driven by a combination of factors. it's driven definitely by risk considerations. And so there is a difference between different types of investors. And we will talk about this in a lot more detail when we talk about debt and equity and differences. Again, I'm sure you have covered this in corporate finance, but maybe you haven't seen this in this applied way. But of course, as a debt holder, you have a very different claim on the business. You have a contractual claim, so you get the promise of an interest payment. So in a way, this is a flat payment. Yeah. So if things go really well, it doesn't help. You only get your interest. You don't get more. If things go wrong, well, you might suffer because you have a default risk. As an equity investors, as a shareholder, you have a residual claim, which means you get the leftovers. And there the upside really matters. Of course, also the downside. But if things are going well, so if the cash flows are going up significantly, your residual claim goes up. So they have a different risk profile, and this also has implications for decision making, and also implications for expected returns. Yes, as a matter of fact, the cost of debt and cost of equity are different because of that. And again, this is of course covered in corporate finance lectures. So you would of course assume that cost of equity is a lot higher than cost of debt. The interesting question is by how much, and there is a big difference between what corporate finance academics might do and what practitioners do. They tend to focus on more rule of thumb guides on this difference. And we talk about this in more detail in the next units, but basically at the moment what we need to understand is when we talk about cost of capital, this is basically our benchmark. So put differently, if we make a profit as a business, it doesn't mean anything. Yeah? Making a profit isn't good enough. What we have to do is we have to return more than expected. So our return on our investment, and we talk about this next unit, return on invested capital, has to exceed our cost of capital. Yeah. So when you always hear also in the media, oh, the business is making a profit, it's meaningless. It's not about profit, it's about making a return in excess of what is expected. This is the only way you actually generate value. Cost of capital is also called the weighted average cost of capital, and again, this is most likely covered in corporate finance. This is just a matter of calculating it, and we talk about this, and we will talk about taxes and tax shields and all these different issues that will affect our calculation of cost of capital. Again, this is in terms of financial modeling one of the aspects that is quite important. Now, net present value calculation, I'm again sure this is covered in other courses. For me, again, I want to really focus on the application side of things. So the idea, of course, is that money flows depend on timing, and time, of course, has value. That's the main idea. And so when we talk about value, we actually talk about discounted cash flows, and we talk about this in a lot more detail in the next unit. Good, so I basically now covered what I wanted to cover. We will do some more exercises, in particular once I'm there in April. I will see you in the next unit.